In 2001, Argentina's government froze every bank account in the country overnight. People woke up unable to access their own money. ATMs went dark. Stores stopped taking credit cards. Within weeks, the middle class was bartering household items for food. The currency lost 2/3 of its value in a single year. And here's the uncomfortable part. The government didn't run out of money because of a natural disaster or a war. They ran out because of decisions made in boardrooms and central banks. Decisions that seemed reasonable at the time. Decisions that dozens of countries are making right now. So what actually happens when a nation's finances collapse? Not the Hollywood version, the real sequence of events. Because it's never just one moment, it's a cascade. Let's start with what it means for a country to run out of money. Because this phrase is almost deliberately misleading. Countries aren't like people. You can't check a government's wallet and find it empty. Nations have central banks, tax systems, the ability to print currency. So when we say a country has run out of money, what we really mean is it can no longer pay its bills in a way the world accepts. And that distinction matters. Here's how it usually starts. A government spends more than it collects in taxes. This is normal. Almost every country does this. To cover the gap, they borrow by issuing bonds. Bonds are just IOUs. Investors buy them because they trust they'll get paid back with interest. But trust is not a constant. It's a market price that updates every second. When a country borrows too much for too long, or when its economy weakens, or when inflation creeps up, investors start to worry. They demand higher interest rates to compensate for the risk. Now the government has to pay more just to service its existing debt, which means it needs to borrow even more, which makes investors even more nervous. This is the spiral. Greece discovered this in 2010, Lebanon in 2020, Sri Lanka in 2022. The mechanics are always the same. Debt becomes expensive, then unaffordable, then impossible. At some point, the government faces a choice: default on your debt or print money to pay it. Both are catastrophic, but they're catastrophic in different ways. Let's talk about default first. When a country defaults, it's not like missing a credit card payment. It's a legal and financial severing. The government announces it cannot or will not repay its debts. Bondholders lose money. Credit rating agencies downgrade the country to junk status. International lenders disappear. Suddenly, the country is locked out of global markets. It can't borrow to pay for imports, can't finance infrastructure, can't roll over existing debt. And here's where it gets personal. The government runs out of foreign currency. Most countries need dollars or euros to buy oil, medicine, technology, anything from abroad. Without access to these currencies, imports freeze. Shortages begin. First, it's luxury goods, then it's essentials. In Venezuela, this meant no insulin, no chemotherapy drugs, hospitals without anesthesia, not because the country lacked money in the abstract, but because it lacked the specific money the world wanted. This is the hidden brutality of sovereign default. The government still exists, it still prints its own currency, but that currency becomes worthless outside its borders. And for a globalized economy, that's a death sentence. But default is actually the cleaner option. The messier path is printing money. When a government can't borrow and won't default, it orders the central bank to create new currency. This isn't metaphorical. They literally expand the money supply. More bills, more digits in the system. At first, this works. The government can pay salaries, fund programs, service debt. Everyone breathes easier. Then, prices start rising. Because money is only worth what it can buy. When you double the amount of currency without doubling the amount of goods, each unit of currency becomes worth less. This is inflation. And if the government keeps printing, inflation accelerates. Zimbabwe tried this in the 2000s. By 2008, inflation hit 89.7 sextillion% per month. Sextillion. A trillion trillions. Prices doubled every 24 hours. The government printed a $100 trillion bill. It couldn't buy a loaf of bread. People used wheelbarrows of cash for simple transactions. Then they stopped using cash altogether. They switched to US dollars and South African rand. The local currency became decoration. This is hyperinflation, and it doesn't happen slowly. Once trust in a currency breaks, the collapse is exponential.
People spend money as fast as they receive it because holding it means losing value. Businesses stop pricing in the local currency. Savings evaporate. Pensions become worthless. And here's the cruelest part. Hyperinflation punishes the people who followed the rules, the ones who saved money, who didn't speculate, who trusted the system. They wake up poor. Now, you'd think governments would avoid this, and most do until they can't. Because the decision to print money is rarely made all at once. It happens incrementally. A little more stimulus, a little more liquidity, a temporary measure that becomes permanent. And it's politically seductive. Printing money doesn't require raising taxes or cutting spending. It doesn't create immediate enemies. The consequences arrive later, often under a different administration. Which is why the same pattern repeats across continents and decades. Weimar Germany, Hungary in 1946, Yugoslavia in 1994, Argentina 5 separate times. Each government convinced itself it could manage the printing just a little longer. They were all wrong.
So what does the end game actually look like? Not always hyperinflation or Zimbabwe-style collapse. Sometimes it's a slow, managed decline, a gradual loss of purchasing power, a generation that's poorer than their parents, a fraying of public services that never quite recovers. Greece didn't descend into chaos. It accepted a bailout with brutal conditions. Pension cuts, tax hikes, youth unemployment above 50% for years. The country survived, but at a cost that's still being paid. Other times, the government negotiates a restructuring. Bondholders take a haircut, accept partial repayment, extend deadlines. It's a controlled default. Still painful, still damaging, but not apocalyptic. And sometimes, rarely, a country gets lucky, discovers oil, receives geopolitical support, grows its way out of debt. But luck is not a strategy. Here's the part that doesn't get discussed enough. The social unraveling happens before the financial collapse is complete. People sense instability before the government admits it. They see inflation rising, services declining, corruption spreading, trust fractures. In Lebanon, this meant bank heists by depositors trying to access their own frozen accounts. In Sri Lanka, it meant storming the presidential palace. In Argentina, it's meant recurring cycles of protests, capital flight, and political chaos. Because when a country runs out of money, it's not just an economic event, it's a crisis of legitimacy. The social contract breaks. The implicit promise that working hard, saving money, following the rules will lead to stability. That promise evaporates, and people remember. Even after the crisis ends, the memory lingers. A generation grows up cynical about institutions, about currency, about the future. This is the hidden cost, not just the inflation rate or the default percentage, the erosion of trust that takes decades to rebuild. So where does this leave us? Global debt is at record levels. Interest rates are rising. Growth is slowing. The conditions that trigger sovereign debt crises are not exotic. They're present in economies large and small. And yet the conversation remains strangely muted. Central banks assure us they have tools. Governments promise growth will solve the debt burden. Markets price in optimism. Maybe they're right. Maybe this time the math works differently. But history suggests a different pattern, that countries don't run out of money in a single dramatic moment. They bleed slowly. They make incremental decisions that seem rational in isolation, but compound into crisis. And by the time everyone realizes what's happening, the cascade has already begun. The question isn't whether it can happen, it's whether we'll recognize it when it does, or if we'll still be debating the early warning signs as the ATMs go dark.